Happy St. Patrick's Day, everyone. Jim Iuorio has spent years in the trenches as a trader and an institutional derivatives broker and an investor who, among his many interests, owns a Chicago area restaurant famous for its burgers and its association with Al Capone. We're going to talk to him today on Open Interest. Hello, everybody, and welcome. I'm Mike Coe. Welcome to Open Mic, and happy St. Patrick's Day. And it's a good one because today I'm joined by my longtime friend and colleague, Jim Iuorio. Jim has spent decades on the trading floors in Chicago, but his insights are particularly helpful for another reason. As the owner of a well-known Chicago area restaurant, Brant's of Palatine, and owner of numerous rental properties, he may be able to offer us some insights on the consumer. Jim, how are you? It's good to see you, my friend.
Good to see you. I miss talking to you. You're, and I say this behind your back, and I'm not lying here. I think you're one of the smartest guys I know, and I love the way you break things down. And I think it's an honor to be on your show right here. Thank you, Mike.
Well, I appreciate that.
Okay, now let's talk about your outfit. Why are you wearing a suit and tie? I thought we were just a couple guys hanging out.
So my brother, who is, one of the producers of this, he said, "What's with the tie? Do you have another hit or a meeting or something going on afterwards?" I was just looking for something a little green to throw on. I don't know
that
the
makes
last
more
time.
sense then.
I don't know the last time that I actually threw on a tie. Actually have a question for you. On the Merc, did you guys have to wear ties back in the day?
So yeah, we did probably up until about 10 or 15 years ago. And it was so funny because the rule was just that you had to wear a tie. So people would try to outdo each other for how crappy the tie would be. Like it'd be literally threads, and you had to wear collared shirts. So the real rebels would wear like a rugby shirt that had a fake collared shirt and then a tie that was in threads hanging down. I tried to be a little bit above that. I did wear a nice pressed shirt and a tie, but as soon as they told me I didn't have to, I stopped doing that.
So I think this is probably true on almost all of the exchanges, because in New York we had the exact same deal, and actually there were vendors out on Trinity Street that would sell these ties for $3, and the habit for most of the floor traders was, because people who don't know, on the trading floors usually there's a member's coat room, you have a trading jacket, some people would wear a suit in, but most people would actually just have their tie like this. They would loosen it up, pull the thing over their head, stuff it in their trading jacket pocket, and in the morning they put their trading jacket on, go like that, and zip it up. And this is, a pretty, rough place. People are eating and standing on their feet and bumping into one another. And, they're not washing these ties. They're pretty gnarly. And as you point out, yeah, I've seen more than one trader sporting a tie over a golf shirt.
I'll add one thing to it as well, Mike. One time, me and Teddy Cohen, who ended up being a buddy of mine, got into a fight in the trading pit, and he did grab my tie and took me down to the ground with my tie, and it ended up on my head when I was trying to get out of it. But what other place of business do you get in physical fights? The trading floor was wonderful.
It was remarkable. I'll tell just another couple quick stories. We had a guy who was sort of a roaming trader on the Amex. He worked for Susquehanna. He was, among other things, also my Shotokan karate instructor. And now, what people may not know is that the trading pits, it's a club. So the exchange itself is a club, but individual pits are also a club. And traders are all competing with one another. So new traders are rarely welcome. And this guy would show up when he heard there was a lot of action going on in something, and he would come in. And, as you point out, sometimes people would start yelling at each other. Maybe there'd be some pushing and shoving. And I've seen worse than that. But in this case, he was well known to not shy away from a fight. But he always had a very calm demeanor about it. And I can remember very distinctly we had a really busy day in the Philip Morris options. You may remember back in the 1990s, there was always a question about whether those companies were going to go out of business because they had these big class action lawsuits. He came into the crowd, and a couple market makers started, basically trying to push him out. And he very politely said, I don't think this is really the time or the place, but, if you want to grab a beer after work and talk it over, I'll be outside. So that was the end of that conversation. He traded 10,000 options in about 5 minutes and then walked out.
But and in our pits, I love that. By the way, in our pits, if you came in when you had a big order, like if you were the broker for some huge hedge fund, then you were more welcome, obviously, right?
Oh yes.
Yeah. Okay.
Well, this is it's an interesting thing. So you've spent most of your time trading futures options and things like that, right?
Yep.
More than equity options.
Yep.
And the Merck rules, so I was on the Amex affiliates, but also the NYMEX. And the distinction on the futures floor was that, I was a trader, but on the NYMEX floor, I don't know if this is true on the Merck, I assume it was, a broker could both trade for their own account or represent a customer order. You couldn't take the other side of your own paper, but on the other exchanges, you were either a trader or you were a broker. It was either one or the other. On the Merck, could you do both?
So the first 10 years, maybe 15 years, I was involved in. This is an almost 40-year career now. I know what you people are thinking. You look like you couldn't have been there more than 9 years, and thank you for that. No, what I'm saying is that the first 10 or 15 years, you couldn't trade and broker, and then they lifted or relaxed some of those rules, and then people could. And it's interesting. Both ways it was interesting. And you could take the other side of your order if you called it out 3 different times and nobody wanted either side of it at the Merck.
Oh, that's interesting. Yeah. So, as people could probably understand, there would be a potential conflict of interest in an open outcry pit. Everybody's supposed to hear, and people are supposed to be competing over the order. One other thing people may not know about Jim is that Jim was also one of the earliest contributors on Options Action when the show first started. When that show first started at CNBC, it was not actually a live show. It was what we call live to tape. And there was a studio at Englewood Cliffs, and we would all show up there. And the earliest participants on that show, other than Melissa Lee, was Jim Iuorio, Joe Terranova, who ended up taking Dennis Davitt's place after Credit Suisse said he couldn't do it, Stacy Gilbert of Susquehanna, and myself. And I remember when you stopped doing that show, I don't remember exactly when it was, but I remember the very first comment after that show that my wife Holly said, what happened to the guy with the big ears? I loved him. He was the only funny one on that whole show.
I love that. That's so funny. Because I'm mostly self-conscious of my nose. I sometimes forget I have big ears too. Thanks, Holly.
Well, you were her favorite on that show,
That's
so
awesome.
She was really disappointed. I don't know that she ever watched it after you left it, actually. I'm pretty
really
sure
awesome.
she didn't.
I love it. Yeah.
Anyway, are you a contributor on Fox now? I think you are, right? Or you were for a while.
Okay, so my own media stuff has really taken off quite well. And I don't want to be signed to anything else at the moment. So I go on once a week, maybe twice a week with Maria, Charles Payne, or Larry. Larry and I are still tight. I do his radio show once every third week where we talk for a half hour. Larry Kudlow for people watching. But I'm not a signed contributor, because I'm part of the Futures Edge, and part of, Bobby and I have the several different podcasts that we do.
Tell us a little bit about those.
Okay.
Because, some of the people watching might be interested in getting your insights.
Okay, so the Futures Edge has been going on for 2 years. We record it every Tuesday, and it's just started to be live within the last few weeks. 60 to 70% of the shows are macroeconomics, finance, and trading. Now, something's happened over the last year, which is kind of interesting, is that we've had some politicians and some health experts specifically, because one of my things is that health is one of the biggest economic issues we are currently facing in this country. We have just, in my opinion, a rampant metabolic dysfunction problem, and I think it's a huge economic thing. So that's how in my head I kind of made the deal to have doctors on, like Dr. Robert Lufkin, who wrote The Lies I Taught in Medical School, Dr. Sean Baker, who wrote The Carnivore Diet. We have these people come on and we talk about health, which I think is a ton of fun. We've talked about ice baths and cold therapy, but now back to the macroeconomic part. We often have Luke Groman, Brian Westbury, Jim Bianco. We kind of have our stable of people who come on. I went to Bobby Iacchino with this a couple of years ago, and I said, as long as I don't have to do any of the work for this shit, as far as booking guests or production, I'm in. And he's like, okay, great. So we hired a production team, and it's gone great. We also do a show for Tradier, who you're familiar with Tradier, and we do a show for them every Wednesday live.
Oh, that's awesome. Well, people should definitely check that out. It's the people that you just referenced are all seasoned professionals. I consider
as are
myself
you,
a seasoned
and there
professional.
has been a reason where I have not contacted you to come on, and I will speak to you again because hopefully that reason is not what I thought it was before. But we'll talk later.
Yeah, all right. Well, definitely.
Yep, it's on every different platform. It's on Apple Podcasts, Spotify, YouTube. We release it on Twitter then eventually as well. It's get pretty good traction. Each show gets probably 80,000 views across platforms, maybe more sometimes. So it's been going good.
Oh wow, that's excellent. So one of the reasons I was really excited to talk to you today, and we were just talking about it before we went live, that my son is working in a restaurant to earn some extra cash. The deal was that we don't give our kids a lot of spending money. We want them to go out and get jobs and learn what it's like to be in the working world and interact with people and pay their own way to a certain extent. And in addition to your experience trading, and you've traded damn near everything, which makes your insights particularly important. And also, I've always felt that people who have traded in the futures markets and have traded any commodities are, maybe in some ways a little bit more in tune with the things that matter to self-directed investors who are more active traders, because you are, more in tune with basically the supply and demand dynamics that impact prices. Whereas my own background was, quantitative analytics and derivatives trading and deep dive fundamental analysis at the hedge fund. So generally speaking, we were looking at, okay, we think this thing is worth $3, so we're very happy to pay 2.5 for it or sell it at 3.5, something along those lines. But I didn't pay that much attention to, price patterns and things like that. What are the things that you spend most of your time and attention on? And what would you say the average holding period is for a lot of the trades you do?
So the trades I do, I try to have an average holding period of about 2 to 3 weeks. What do we call that? Swing trade or whatever. So I definitely put on options to define the risk. I day trade, and I day trade almost every day. I just break even day trading. Day trading for me is just keeping my feet in the water so I can feel the temperature. But where I actually make money is trade horizons that are about 2 to 3 weeks, usually options, a lot of either buying or selling volatility, a lot of like somewhat directional plays with call flies and put flies. So that's where I actually make my money. And I do that across all different assets as well. I do it through all the futures. I do it in my with my equity trading account as well. And that's where I've had the best luck. But to your point too, guys who have been in the interest rate markets as long as I have too, we start to tend to feel that interest rates and currencies are like the dog and everything else is the tail. I'm not sure if that's the right way to look at it, but that's the way I've always looked at it. And it hasn't led me too far astray many times, because I do think there's some validity to it. If you watch rates and you watch currency movements, a lot of times you get signals to what's going, in my opinion. Does that sound reasonable to you or no?
No, it seems completely reasonable. The way that we often like to think about things on the even on fundamental analysis, rates play a big role. First of all, because if you're discounting future cash flows, but the other thing is it's a relative value issue, which is that, most people look at stocks, PE ratio, they look at the market's PE ratio, things like that. Those are kind of the simple metrics. Maybe they look at the free cash flow yield, enterprise value to EBIT, enterprise value to EBITDA, and then at growth rates. But interest rates capture so many of the things that matter. They are the discounting variable, which is obviously critical. They are an indicator of future inflation and growth expectations, which is obviously also critical. And, it is the relative value thing. So if, you have a stock that's got a PE of 20, you invert that number. So 1 divided by 20 gives you the corporate earnings yield, and then you can compare that to the risk-free rate. Well, a 5% rate that's growing at 5, 6, 7% a year might look very attractive in an environment where the risk-free rate is 2%. It might look very unattractive in an environment where the risk-free rate is 8%. Right. And especially that growth perspective, right?
Yeah, and I love what you're saying too, because I love that Greenspan model too of earnings yield versus whatever the investable treasury is. I used to discount 3 month and up to 1 year, but whatever, like between 5 and 10 years versus the earnings yield, I thought was a valuable metric. I've kind of switched over the last few years, and I think that money supply growth, Fed balance sheet growth are a little bit more of a better metric for me where stocks go now. But you mentioned something a second ago. Let's see if I'm, oh, so I wonder sometimes, like you said about changing your investment patterns based on returns. Like, would I have bought a restaurant 13 years ago if yields weren't 0%? Like, if I could have gotten a 8% treasury, would I have just put 8% in a 30-year treasury and not plucked out money to make some money in a restaurant? Maybe. You know what I mean? I think it's a very interesting thing what people do when they're sick of making 0% interest on their government bonds or any bonds. And I think it's very fascinating.
Well, let's talk a little bit about that restaurant. I know this is a story you've told many times, and I've seen you even interviewed because I know that Brandt's has something I haven't tried yet, which I know is a famous burger. You guys have won awards for this burger. But tell me a little bit about what led to the purchase of the restaurant. You know, what went on that got you into this game, because you already had so many hats on, don't you? How many rental properties do you own in Colorado at this point? It's a pile.
We sold one. We're only one property in Colorado, one an additional property in Palatine, and we sold an office building that we owned in Downers Grove all recently. So I'm just down to 3 properties now. So, but anyway.
Okay. So you're shrinking your real estate footprint.
Exactly.
Viewers take note.
It's just profit taking.
Tim's doing.
Yeah, it's just profit taking. You know what I mean? I still like the real estate market, but I just had a lot, and there was opportunities that popped up for those properties, and we dumped them. My wife used to run her law office out of the office building we owned in Downers Grove, and when she decided to retire too, then it was just like being a property manager, not on site. So I didn't like that as much. But we made good money on all the properties we've bought. But the restaurant is a fascinating thing. Okay, so we're 28 miles outside of the city of Chicago, northwest. Huge old bootlegging area, gangster area. And there's a bar restaurant called Brandt's that has history rooted, like you said before, to Al Capone, gangster named Roger Toohey. The story of the restaurant is magnificent. It was a 4-year war between Toohey's gang and Capone's gang, where hundreds of people died, including the mayor of Chicago, because the mayor of Chicago switched his allegiance from Capone to Roger Toohey, who owned the bar that I own. And then the Capone gang ended up killing him in Bayside Park in Florida, which is at an FDR event. Because this is Chicago stuff. But anyway, so we've been going to this restaurant since we were kids. The best cheeseburgers anywhere, wins awards, best ribs. And all of a sudden we find out it's going into foreclosure. When I say we, I'll introduce the second character in this as well. We find out it's in foreclosure. We know why. The previous owners, the guy who sells the cocaine was pulling up to the back of the restaurant. The kids who worked for the owners were robbing the cash register blind at least once a day to satisfy their drug habits. It was a crazy, crazy thing that this great product was going to business. So now this comes back to equities and markets, because now it's Motorola. I'm steeped in Motorola territory out here. And one of my buddies is the CIO of Motorola. We went to grade school together. We went to high school together. So Motorola splits in, but you're thinking I'm going off on a weird tangent. I swear to you, I'm going to pull it together and put a bow on it. So Motorola announces they're splitting into solutions and mobility. You remember it well. Okay. Mm-hmm. You and I know why they're doing it. They're going to sell off mobility. And eventually, and they do. So they sell it to Google. And I knew 2 things happened. My buddy, who's the CIO of Motorola, who went with mobility, is going to lose his job and be looking for something to do. And he's going to get a very sweet check that's going to get slid over to him from Google when they buy him out. So I start planting the seeds. I rope him in. He runs it. He still runs it today. We've actually made quite a bit of money on this restaurant not because of our business acumen or how smart we are. It's because it was just such a brilliant model that should have made money, except for the bad habits of some of the people involved. So then that was 13 years ago. Even this part, this is how lucky I am. We agreed to the price 13 years ago. Okay, the guy who's selling it, he says yes. And then a week later he says, no, I'm backing out. A week later he says yes. This goes back and forth for a year. A year later, it's about to go to an auction for foreclosure. He calls us on a Sunday and said, can you close on a Wednesday? Which, by the way, is awful, because you don't want to have to free up that kind of money in 4 days. But most of my stocks hadn't really recovered, so it wasn't a huge capital gains tax thing too. But the beautiful part is that we went with the price that we had agreed to a year ago, and in that time, as you know, this is 13 years ago to 12 years ago, property values are going higher. The economy is getting better after the Great Recession. So even going into it, we were like a couple $100,000, which I feel the slightest bit of guilt Not very much, by the way, because, I mean, it just, we gave a bid and they hit the bid, but we were already like a couple hundred is it in the red or in the black, whatever the good one is, right as soon as we signed the deal.
Yeah, so that would be in the black.
Okay,
usually.
that's what I'm thinking, in the black.
Maybe I think red's a lucky number, lucky color in China. So maybe in China they have it inverted. I don't know. I'm part Chinese. I should know these things.
And I should know what in the black is.
You've only been trading for 40 years.
Exactly.
One of these days you're going to find out you didn't make any money all this time.
Wait a second. That's what in the red means. Shit.
So I have a question for you. I mean, one of the observations that my older son has made is that he has been seeing a decline of foot traffic in the restaurant where he's been working. Unless, as we previously discussed, it was somebody coming in to steal something and run off. That there was that kind of foot traffic.
Fast food.
I was I was regaling Jim with the fact that my older son is a running back, so he ran down the missing food. But I was just curious, what you are seeing in terms of consumer, and also just because as somebody who's traded rates for so long, I'm also curious to get some of your insights with the Trump administration here and, some of the policies. So, Scott, I'll just throw it out there and then let you sort of opine on all of these things. Scott Bessent made the comment that he wasn't sure whether or not we were going to go into a recession. And Donald Trump, when he was being interviewed by somebody else, said that it was a question he preferred not to answer. But what he also added was that the administration is definitely making an effort to avoid an inevitable fiscal disaster, if they don't act. So, as a rates guy, I'm just curious to know, what your thoughts are on what we're seeing.
So, starting just from the rates perspective, and then we're going to get back to the general economic thing. From the rates perspective, there's a theory that's being bounced around, and I'm curious if you give it any credence, because I give it about this much, that engineering some sort of market slowdown that could, in fact, start a rotation out of stocks into bonds, could lower longer end rates, allow them to term out their debt a little bit more. What is it? $9 trillion of debt service or debt that's rolling over in 2025. There is a thesis that perhaps they are willing to put up with stock market weakness this time because they know they need to borrow money cheaply, because 2025, you can talk all you want about cutting spending, about reducing deficits. I personally think deficits are going to go higher, not lower in 2025. I think the things that are doing are somewhat necessary. I do think the path we were on as far as spending goes, running up to almost $37 trillion, I thought that was unsustainable. And I think that is not a radical position. What's radical is saying, well, I think it blows up in a year, 5 years, 10 years, 15 years. We can argue all day about that, but you'll give me that's not a radical position, that the path we were on is unsustainable, correct? Before I move on?
I will absolutely give you that.
That's what I thought. Yes. Okay. So now what we're seeing now, you mentioned before about the higher end consumer. As you know, 10% of the richest, the wealthiest 10% were driving 50% of the consumption over the last, I believe it's 2 years. Some of my numbers might not be exactly right, but as Mike knows, I'm generally in the ballpark. This is thumbnail stuff. So I thought it was a K-shaped recovery after 2020. And if it's a K-shaped recovery and now all of a sudden we're reducing some of the wealth effect, it is perfectly reasonable to think that we are going to see some sort of a slowdown. This is what I think. This has been my base case, by the way, since the beginning of the year. Now that 2025 was going to be a rocky year, despite the fact that we're getting exactly what he said we were going to get. But the problem here is that he has 2 years to do what I think would be much better done in 5. He doesn't think he has 5 years to do it, and he has to get good and tangible results before the midterms elections in 2026. So I think that puts us in a precarious spot. Where it ends, I think it ends okay, but I'm not 100% sure of that. Now, as far as like foot traffic at restaurants, my restaurant is upscale pub. Like the burger we mentioned before is, highly sought out. It's about $18-19 for the burger plate. It's not Shake Shack. The ribs are $25, but we're an affordable luxury to people. And we only raised our prices 20% over the last 3.5 years, maybe 25, where everyone else raised them 40%. Our business model was that we were going to take it on the chin personally, me and my buddy, in order to build customer loyalty, which it seems to be working. Most mom and pop restaurants aren't in the same position we are, which is unfortunate, but we are seeing a lot of restaurants close, particularly ones that are a little bit higher end. So I think within the next 6 months, there's going to be pain. And I hate even saying it, because when guys like you and I say there's going to be pain, we don't mean pain for us. I wish it was a different way. We mean pain for the lower end consumer. And that's really going to happen. And I think it's part of the whole, I hate to call it a master plan, because I'm not convinced these guys know exactly what they're doing. I hope they do. Does any of that make sense to you?
No, it makes a lot of sense. And, you could probably speak a little bit. I actually happen to have, I pulled it up on one of the things that a lot of people have been talking about lately, and it's obviously an expense side item for you as a restaurateur. Everyone's always talking about eggs, of course, and the increase in the price of eggs. And what I did here was I actually pulled up, and this is for anybody who's interested, assuming you trust government data, and I actually trust Federal Reserve data generally, I would say. What I did was I started pulling up some of the prices for a lot of food items over the course of the last 10 years. So eggs, obviously, this is one of them. They're hitting essentially these all-time highs here. And one of the reasons they're hitting these all-time highs is because, of course, we have this avian flu thing going on. And I didn't really think, because everybody's making a big fuss about that, I think that there's an exogenous event, an idiosyncratic event that's going on to the extent that the avian flu is idiosyncratic. We've seen it more than once. But, when you cull a couple 100 million chickens, the net result is that you're going to have fewer eggs. And if you have fewer eggs and demand doesn't drop commensurately, the prices will rise. But we don't have the same idiosyncratic events going on in other food commodities. So, I thought it would be interesting, so here we have, the 10-year price of eggs. We're at close to $6 a dozen right now. And you can see that the average before these recent spikes was closer to $2. But if we take a look at some things like, for example, ground beef, which is presumably an input cost for you. Now, I know you guys source your stuff, so you're not buying the most generic things. It's one of the reasons your burger's award-winning, I understand. Mm-hmm. But you can see that the price of ground beef is up much more than 20%, certainly off of these 2017 lows. We're looking at something in the neighborhood of probably $3.80 or so, or $3.50 was probably the average, before things really took off in January of 2021. So it was less than $4 a pound in January of 2021, and here we are closing on $6 a pound. Now, I don't know what you pay for the fancy stuff that you put in your burgers.
Yeah, right.
I'm sure. So that's what we're looking at. What we're looking at there is an increase of about 45%. You said you increased your prices by about 20, right?
Yep. And we estimate that our costs overall went up about 45. Now, there's something I want to add, because beef is a huge input to us, and eggs are a minor input. We go through quite a bit of eggs, but not, and they're still relatively inexpensive for what you get. But beef is a huge input. But everybody looks at the restaurant business and we say our expenses have gone up 40 to 45%. They think that's just food input, and it's not. Labor in Illinois has gone, just in 4 years, from like $7.50 minimum wage to $15 minimum wage. Now, by the way, we like to hire a lot of kids, high school kids. It engenders kind of a sense of community, and we like to be a training ground for them, a work ground for them. They're not really worth $15 an hour, but anyway, that's double. Now, when you're talking about some of the minor item things like straws and coasters and things that are priced relatively cheaply, I mean, I understand when you buy them in bulk, they're not. Those have gone up more than 25 or 30%. While everybody's looking at beef and pork and eggs, things that you wouldn't even think of have gone through the roofs. So that's why our aggregate expenses, including taxes have gone up a ton. I think in these states like Illinois, which I don't know if they're stupid or nefarious, but it always seems like when the mom and pops start to struggle, well, the government starts to struggle and not get as much money as they wanted from them too. So they raise the taxes, not lower them. And that is what they've done in earnest over the last couple of years in Illinois, is raise the taxes, particularly on small mom and pops. So the perfect time. And by the way, we still have a line out the door. We are willing to operate at basically little more than a scratch for the next couple of years in order to get back to where we were before. So we're in a different spot as most restaurants are. But it's the inflation aspect of it has been wildly underestimated by the people at large.
What about energy costs?
Energy costs. I forgot to even mention energy costs. Yeah, energy costs have been a huge uptick for us as well. Yeah. And it's funny because
Yeah,
we look at a chart for crude and for electricity, and I don't know what is that chart you have right there?
that's
Yeah, that's
electricity
electricity.
per
Electricity is
kilowatt
going
hour.
through the roof. The other stuff,
Hmm.
the oils and things obviously have not, but the electricity's gone through the roof. And those are a big deal to us. We have an outdoor space that we box in the winter and heat it. It costs a couple $100 a night to heat it now. And we do it. Like sometimes we'll do it on a Monday or Tuesday night just to make sure people know that it's an option and nobody's sitting out there and it's $200 down the drain for heating that thing in a 10-degree day.
That's right. It gets pretty cold up there.
Yes,
So,
it does.
it's interesting because in the midst of all of this, and I know that, Illinois' situation is a very different one than Florida's. Maybe it's not that different from my home state of California, but I recently heard DeSantis saying something to the effect of that they think maybe it's appropriate that they should eliminate property taxes in the state. And he made some kind of a comment that said, once you buy your house, I have a hard time understanding why you're then obligated to rent it from the government. So
preaching my language there, preaching to the choir, whatever that expression is. So yeah.
But I think it's kind of interesting because, what it speaks to is that, in the United States, each state is its own little lab of policy, tax policy, regulatory policy, and people can vote with their feet. And if they don't like what's going on in one place, they can move to another. It's pretty clear that Florida and Texas are seeing big inflows from states like California and I assume from Illinois. I don't know much about the
Illinois
migration
is a huge
patterns.
outbound state, either first or second in outbound states each of the last 10 years.
I do remember, many, many years ago, long before I got married, I dated a girl whose father was, he had a big seat on the Merc, he had a seat on the SIBO also, and he lived outside the city in Lake Forest, which for people who don't know is a pretty nice community. I had never been there until I went to her house, and I was pretty blown away. I didn't know that a lot of houses built at the turn of the century had elevators, but hers did.
Wow.
But the other thing that I remember, it had something like 13 bathrooms, 11 bedrooms, an elevator. It was on the lake. Wow. It was pretty outrageous.
That's amazing.
But the thing that amazed me was that, over the course of the years, I was taking a look at the prices, because that's the first thing you do, right? You think, wow, look at this, what does it cost to even buy a house around here? And the thing that amazed me was that I would periodically check, and it just seemed like the prices there where, Manhattan was taking off and South Florida was going up by multiples. I would see these mansions in Lake Forest just linger on the market and actually end up going lower and lower. And I thought there's no way that you could, if you got the land for nothing, there's no way you could build the house for the cost they're asking for it on a per square foot basis. I was seeing, these places that were just, incredible craftsmanship, mansions, really, that were being sold at prices per square foot that was like builder's grade if you were building that in Oklahoma, that kind of thing.
It's absolutely, it's crazy. And like you said, Chicago's an old city with an old history and old money too, particularly because a lot of it comes from the fact that the futures markets were here because it's where the railroads met. So that's where futures started, trading agriculture futures. And a lot of people made a lot of money. So there was old and cool old homes. But it always seems like the Midwest, Chicago area has been oftentimes insulated from the big price spikes that happen on some of the coasts and some of the more attractive areas geographically. But it also seems to be a little bit more insulated in the downturns too. Now that's the exception of 2007, 2008. Everyone kind of shared in that pain as well. One thing I'd mention about Illinois as well, though, when you talk about California being an outbound state, and California has every geographical advantage, not just over Illinois, but probably of any other section of land in the world. Can you think of any place that is as big and diverse, has agriculture, has tourism, it has everything you want in California? For them to have messed that up with ridiculous high taxes and still driving people away is unconscionable. Florida doesn't have near what California has, in my opinion. They have nice weather and nice beaches, and I go there. I just got back from spending, part of my winter there. But California, all they have to do is flip the switch to sanity, and I think they would reverse the trend. I'm not sure states like Illinois can do that. And by the way, you mentioned Illinois as being like the affordable option. Well, when you live in Illinois and people go to school in Iowa and Indianapolis and, all around us here, Chicago in this region, in the Chicago area, is like the expensive place. And when you compare it to New York and California, obviously that falls apart.
Well, yeah, it's, California obviously has every possible thing going for it. 40%, I think, of the produce sold in the United States is grown in California's Central Valley.
Do you remember
I don't know
a quick thing? Who was Sam Brownback was the governor of, was it Missouri or Nebraska or whatever? But anyway, they instituted they did some policies at the same time. And I remember hearing these economists acting like, well, this is going to be a good comparison. I can't remember if they raised regulation and taxes at the same time. But anyway, and California did fine and Missouri did poorly. And I don't think it was Missouri. It might have been Nebraska. And everyone's like, well, see? I'm like, no, not see anything. California has the advantages. Are you people nuts? There's been, since the advent of air conditioning, there has been a gravitation, a migration from cold to warm. Even within states, there's been a migration from rest of state to like southern, particularly where they have, college places like Austin and Nashville. So this is exacerbated that, obviously. And it's just pretty amazing, the fallout.
Yeah. I mean, here you don't actually even need air conditioning because we get natural air conditioning from the Pacific. So it's never that hot and it's never that cold. So it's pretty remarkable. We have a number of people who are watching here, and I thought maybe we could take a couple questions. So I was I'm probably gonna fire them in your direction because most of the people who watch this probably hear far too much of my voice.
They know what you think.
Right? They know what I think, and they know what I sound like, and they also know that there are few sounds sweeter to me than that of my own voice. But I'd like to hear yours this time.
Amen, brother.
So. Michael Kane asks us, do you believe the worst part of the sell-off is behind us?
So I believe the worst part of the sell-off is behind us. My target has been 5,400 in the S&P, which marked a 12 to 13% correction. We haven't got there yet. This bounce of the last 2 days is nice, but to me, but from a technical standpoint, it's bouncing up into what we like to call the rotation zone, which is between the 21-day and the 8-day moving average, and it rotates in there, and then it starts heading lower again. That's what I still believe is going to happen. Down to 5,400 is my next objective, which doesn't mean I scoop everything up I can there. That just means I get out of some of the shorts I put on that day. Was it like 3 weeks ago, the day we tried to break out to the upside and were summarily rejected? That's the day I bought. I even will tell you what I bought. I bought a huge put condor that was very, very wide with a high delta, right? So it's been a great trade. I've taken off a third of it already. I plan on taking off another third when we hit 5,400. And then again, if I lose the last third of it because we bounce back, well, then I'm fine. I'm making money on my investments. But so far, it's been a pretty good trade. And so far, I do not believe it's over.
Yeah, it's interesting too because we were talking about rates before, and we were talking a little bit about valuation. So the S&P's long-term average multiple is probably about 18 times forward. I think we're somewhere in that 20 to 21 times now, and so if you think about a discount of, call it, another 5% on the market. We're getting into that neighborhood. And take this other thing into context, which is we were talking about rates before. The multiple you're willing to pay for equities is related to whatever the rates are. So while I know that 4.5, 10-year, this seems high for people who got into the markets in the last 15 years. But if you've been in it longer for that, you would know that have is a very low number. I mean, a 4% 10-year rate when Jim and I got into this business, that would have been a floor. You could hardly imagine that it was going to get much below that.
Yep.
And yet here we are. So in the context of 4.5% rates,
can I add something to that too as well?
Of course.
Like every time we start to see a downtick, and this is people, and I'm a bit older than you, but the people who are somewhat contemporaries. Every time we start to get into a corrective mode, everyone like hides their their head and think, could this be the big one like in 01 or 08? Well, no, in 01 and 08. Was characterized by this unbelievable amounts of weak hand leverage, mom and pop leverage, particularly the real estate market too. The huge rally in the stocks, and rallying just about everything else. Much of that was just a function of money added in the system and the devaluing of the dollar. Remember, if they're trying to say is, I don't believe that there's any sort of massive reckoning, bubble popping where we're down 40% like we were in 2008. I think this is relatively run of the mill corrective phase. Do you share that opinion or no?
I do, and a lot of people had shown me charts. I think Elliott Wave or somebody had circulated a chart that basically was showing valuations were at sort of bubblicious peaks circa 99 2000 era, which you and I both lived through.
Yeah.
And I found that very curious. First of all, I think there were some flaws in the way they were doing their calculations, in part because they were double counting some stuff. For example, they were looking at CAPE and they were also looking at trailing PE. Well, trailing PE and CAPE is 10 years, trailing PE is 12 months, but you're double counting when you do that kind of thing. The other thing is that you and I both remember very well that in the dot-com bubble, what subsequently became the tech wreck, there were the biggest, highest flying companies, many of them weren't making any money at all. In fact, many of them were losing money hands over fist. That, if we think about probably the best known stock these days, NVIDIA, that's not the story.
No, they make money.
They're printing money.
Yes.
They got 70% margins. I mean, it's true we've never seen anything like it, but it's not the same kind of anything like it. The only thing that I worry about with some of those companies like NVIDIA is that sort of pigs in a python thing where, you can't take the growth that the company has experienced over the last 3 years, take 3 data points, plot them, and draw a straight line that just goes from the lower left to the upper right. Because at some point, the law of large numbers is going to creep in. But it was quite astonishing. I was showing a chart of NVIDIA to somebody and just talking about the fact that it was a $3 trillion business. And I said, this thing was actually trading at something like 26, or when it fell to these recent lows, it was trading 26, 27 times forward earnings on a 30 to 40% annual growth rate.
Yeah.
I mean, under normal circumstances, that would actually be a screaming buy.
Seem reasonable,
right? You'd love to buy a business like that.
So I have a question for you too, because a lot of these people I've heard that many of the talking heads start talking about valuations and then removing the Mag 7 from the valuation equation, and things look a lot more reasonable. I personally don't think that's the most valuable exercise, because if we're going to sell the Mag 7, they're going to drag other things down too. So if you're thinking to yourself, well, I just won't buy the Mag 7, I'll buy other things that are more attractive. No, the vacuum will happen and everything will get pulled down. And if you need any proof of that, just look at Bitcoin. When NASDAQ gets sold, Bitcoin gets dragged down. Clearly, they don't have any sort of similarities, except for the fact that oftentimes the same trading desk that trades NASDAQ trades Bitcoin, so they build up positions in the same thing. But I think that when things starts to fall apart, the rotation doesn't have to be elegant. And many times you'll lose money even if you don't have the Mag 7, even though those valuations are stretched so tight as they were. Not NVIDIA, of course. Thoughts?
Yeah, I mean, first of all, number one, there's so much passive investing now.
Bingo. Yeah.
And if you think about passive investing in a cap-weighted index, most of the money flows into and out of the largest constituents of that index. It's just a mathematical certainty. That's the way it works. There is a lot of passive investing, and I don't expect to see a lot of the patterns of that investment change all that much. The additional point I would make is that the passive investing phenomena is probably more pronounced than many people recognize, because they think about it in the context of SPY, IVV, VOO, and passive investment vehicles like that, the Vanguard S&P 500 index fund. But in fact, a lot of active managers are kind of closet indexers too, because the thing you don't want to do at the end of the year is underperform the index. So if you take a look at the biggest mutual funds and you take a look at the biggest hedge funds and you look at their biggest positions, now these guys are supposedly stock pickers. And then you take a look at what they're, if you actually modeled their portfolio versus the S&P, what you're going to find is that 80% of the performance attribution of the actively managed fund is simply S&P 500. Yeah.
So now that I have
because they simply can't move that much away from the index and expect to stay in business.
And something you mentioned before, when you mentioned the 50 states and how the lab has been set up for 50 states to compete against each other, and people vote with their feet if states screw up. And as long as we get away from federalism, that works, and it's worked well for 300 years. The stock market's the same exact way. The stock pickers are supposed to be looking at, let's say, the 30 stocks in the Dow. I don't trade the Dow. I don't find it all that valuable, but it's only 30 stocks, so it's better for my example. Those stocks are supposed to be looked at independently and capital allocated to the ones that are the best, and the losers to get left out. With the passive investing, just the huge passive investing movement that's happened over the last 20 years, all these boats are being lifted. It creates these somewhat fragile circumstances. I don't know how it's going to play out, but I know that allocating money, without looking as a who deserves it and who doesn't, could lead to a bad thing. But how does that end badly? What does it look like when it ends to you?
Well, I think, first of all, like I said, I think that the incremental dollars that go into the market, that flow is fairly steady. And so what people need to remember, it's kind of like whenever, one of the things that's fascinated me during the pandemic was that people started speculating on all kinds of things. They were doing scam coins, meme coins, Bitcoin. Obviously, they were betting on stocks. They started to bet on real estate. And they started to bet, among other things, on watches. It's like all of a sudden, I had a watch, and I ended up selling the watch to somebody who had liked it for whatever reason. And I didn't realize what was going on. This is the biggest mistake a trader can ever make, is not knowing the market for something. But it never occurred to me that all of a sudden there was going to be this frenzy in, say, for example, Rolex watches. So I happen to have a Rolex watch. Somebody wanted the thing. I was like, yeah, I'll tell you an interesting story. I actually thought that one of my weird superstitions was that watch. Whenever I wore it, I had a bad trading day.
So that guy can have
I'm just not going to wear this thing. So I remember one point I was wearing it, and so somebody said, I actually took the watch off on the desk, and somebody asked me about it and wanted to buy it. So I said, fine, you can buy the watch. But I didn't realize that these things had, taken off.
Yeah.
It was an old Rolex Submariner. I think I'd had the thing for like 20 years, and I didn't realize, because I don't go out and buy watches, so I wasn't paying any attention. I just figured if I ever want one, I can go get another one that gets better luck than this one does.
Yeah. Well, no, let that guy have the cursed watch.
Yeah, and then I later found out that actually you can't go to a Rolex store and buy watches.
Oh, I said, how long has that been? For a long time?
So it turns out, I have another friend. He said, "Oh, you can't just go out and buy a Rolex Submariner or one of these things. You have to get on waiting lists and this and that. You can buy them in the gray market. They're trading 50% over." And I thought to myself, well, that's just the dumbest thing I've ever heard of, because Rolex makes like 1 million, 2 million watches a year.
Yeah.
So there's always going to be more of them.
Yeah.
So I don't quite understand what the phenomena was.
No. So we have to look at things like that to see where the froth is. I didn't mean to interrupt you. Please go on. Yeah.
So when I look at equities, we have kind of the opposite dynamic, which is that we have a growing economy, generally maybe not growing the way it should. But the byproduct of this is that people earn paychecks and they get some of that money taken out. It goes into IRAs, it goes into 401ks. If they have some discretionary money, they invest it in the markets. And what have we not had that much of lately? Haven't had a lot of IPOs. There's not a lot of new stuff coming to market. So a lot of companies that were private have remained private longer. And so what that means is that if you're just thinking about things in simple terms, supply and demand, money continues to flow into equities. Demand for equities persists, but there's not more of them. There's something else that's going on, and that is that companies are operating with far greater efficiency. They seem to be more nimble in many respects now than they were. You can, remember when we were much younger, it seemed like big companies were often driven by whatever consultants and investment banks convinced them they should do. You know what you should do? You should acquire other companies, and they would rack up big investment banking fees, and you'd end up with Gulf and Western. You know what you need to do? You need to divest your business because it's not trading for the value of all of these assets. You should break it up. Well, nowadays, there's not too much criticism you can throw at Jensen Huang, right? I didn't know a company could be that profitable.
It's crazy.
Microsoft, if you had told me that Microsoft would be what it is today 20 years ago, I thought that was a mature business. Yeah. And take a look at what Satya Nadella has done with this thing. Yeah. I'm kind of perplexed, I have to say. I know that Alphabet's got a lot of regulatory concerns, but My general view is that if you just take a look at supply and demand, the demand for equity investment persists. A lot of people aren't looking. They are buying a little bit of the market every 2 weeks without paying any attention to price. Sometimes they're going to overpay. Other times they're going to underpay. And they're going to get more of it when they underpay doing it this way. So I think it's a really intelligent thing for them to be doing. But if I think about it that way, and the other thing is, what's the alternative?
Oh, yeah.
Keep your money in dollars? Well, this goes to the Rolex issue because they keep making more money.
Yeah. Yeah.
So the amount of goods and services that money is going to buy, if the rate of the increase in the money supply exceeds the increase in the amounts of goods and services, the value of the dollar is going to go down. So you'd much rather own assets. I don't really care what they are.
No, and again,
because in the long run, you're going to come out
accused
ahead.
now of being a gold bug, whatever that means, over the last 2 years, because that was our big trade. I gave a speech on it in New Orleans 2 years ago. Why laid out why gold is going to do well. And by the way, part of why I thought it was going to do extremely well, because I thought the other administration, if they won, they would have been fabulous for gold. I thought Donald Trump would be good for gold, but not quite the same as the other. But what we're seeing as far as central bank buying of gold, things like that, and inflation, I think gold is not a good inflation hedge. Gold is a good inflation hedge if you think that there's some inflation and you don't think the Fed's going to fight it effectively, which up until a couple of weeks ago, I think the market believed that, and that was one of the last legs of gold. And gold, I was thinking of gold because you mentioned the Rolex, somewhere in that. Obviously, it's the craftsmanship you're paying for more than there's the melt value, whatever, in a gold watch. But gold is still something that I want to have a very large exposure to, and I still do.
Yeah, it's so in CNBC they have this acronym challenge. Beginning of the year, you're supposed to give your best ideas and you have to spell it out with an acronym. And in 2024, it was BRAVE. The B was for Bitcoin, but the A was for Anglo-Ashanti gold. Yeah. And this year, my acronym was RISING. 2 Gs, one was for GOGL and the other was for GLD. So yeah, I'm completely with you there. We have another question. Well, we got a lot of questions. I don't know if we're going to be able to get to all of them. But this one's for you, Jim. How would you trade futures options differently than index SPY, SPX, or triple Q options, if any difference?
Well, you have to remember that in the SPY options, one contract equals 100 shares. And in futures, one futures contract equals the notional, whatever the contract is you're trading. So that's the biggest difference, too. Within one of the reasons I love futures, and by the way, I've grown up, cut my teeth in futures, so I'm biased towards futures. But I believe the capital efficiency that the futures markets allow you to have, which, by the way, is another word for leverage, which also can get you into some tight spots, and it has before. But the futures markets, you can move a lot more with a lot less capital. Now, I always equate that in my stump speeches for the CME, is that's like having the most impressive power tool in the shed. If you know how to use it correctly, the garage gets built very, very quickly and efficiently. If you don't, somebody's going to lose a thumb. So that's what futures are. Futures, to me, are a little bit more risk, a little bit more of the Wild West. But yeah, I love them still. And I still think you can structure options to define your risk, and it still works out.
Yeah, I think customer portfolio margin has narrowed that capital efficiency gap a little bit, in the sense that people can get, the average self-directed investor can get more leverage if that's what you want. And as Jim points out, there's certainly some risk associated with that.
The exchanges still call it capital efficiency. Guys like Mike and I have been around, call it leveraging the hell out of stuff. So if you're right, great. If you're not, it's bad. Yeah.
I was recounting to somebody very recently that in 1999, right about the time that equity options went multiple listed, so the ISC exchange had come out and a lot of the exchanges were competing. I was a specialist in Tyco options. And you talk about leverage. Boy, we had some leverage because I think I was only trading about $30 million in capital, but the notional value of my positions was well north of $1 billion, well north of $1 billion. And I remember that on a single day, I sold 3.7 million shares of Tyco when it was $100 a share. And the capital base that I was using at that time was only about $30 million. And that was one position out of 150 that we had.
Could you take those overnight, or do those had to be all closed during the day?
It had to be taken overnight because it was not, I had huge positions and you couldn't unwind them. I was the market in a lot of those instruments. So I couldn't have unwound them even if I wanted to.
But to put a further answer on the question is that in futures markets, the option is leverage on a future, which is already leverage. You know what I mean? So in it's not as much that way in cash equities.
And if people are wondering, how is it even possible to do that? We had what is called a JBO. It's called a joint. That's an acronym, stands for Joint Back Office. So we were using Goldman Sachs's balance sheet.
Oh.
And I can promise you, we were doing a lot of dispersion types of stuff at that time. But we got a lot of phone calls from the Goldman Sachs risk department. It was pretty much, it was a daily thing. we're always, what are you guys doing over there? So you guys are both brilliant. Been seeing Jim over the last several years on Fox Business. Always very thoughtful and smart. Well, I wholeheartedly agree with that.
Thank you. It's nice of him to
so
say.
That's
yeah.
Hi, Mike. Bit confused with SPY options when those are expiring and thus auto assignments taking place at 4 p.m., 4:15, or some other time. Oh, so you're okay. Well, this is actually an interesting thing because just following up on the conversation that Jim and I were just having about, because we talked about SPY options and we talked about futures options, and one of the questions was actually about index options. So SPX options are cash. I happen to like SPX options a lot, and I like NDX options a lot too, for a very simple reason, and that is that they're cash settled. So they have some characteristics that are vaguely akin to options on futures a little bit. I've traded options on futures also. But number one, if you don't have a futures account, you can still trade SPX options on your equity account, which is a benefit. You can create synthetic futures with them because you could trade combos. You could get long the call, short the put, and you basically have a cash settlement synthetic future. You can use them for funding, so you could trade boxes, for example, things like that. That's probably not relevant for most self-directed investors, but people who are trying to, make sure they're not up and down a lot of options premium can use SPX for funding things because it basically trades like a zero coupon bond. That's kind of a nice feature. But bringing up expiration was a critical reason why one of the things I did not like about equity options and SPY options and things is that, number one, they're American style, which gives you one more thing to think about, one more thing to worry about, rather than European style options. And that may not seem that important, but I have seen circumstances where people either took assignment or auto exercise in some cases into the underlying instrument inadvertently. And they ended up taking on way more risk wearing basically a long or short delta position through a weekend, or even sometimes longer before they really realized what was happening, because they now held a position in the underlying asset. I think it's less common for people who trade futures because you're just used to expiration happening all the time. You've got futures expiration, you've got options expiration. Right. You want to talk about that a little bit?
Yeah, you're much more cognizant of in the futures, like you said, too. And to add on to what you said, too, about trading equity options and when they can be exercised against you anytime as well. I learned that the hard way too, probably 10, 15 years ago. I had a position in Apple on that I loved that was doing incredibly well. And I would sell calls against it periodically. And I didn't, the call went in the money, but I still had several days to take it off. And, I was just going to take away the rest of the extrinsic. Mm-hmm. And I was going to take away the rest of that. And then all of a sudden somebody exercised me, which doesn't seem like a big deal, except it went against all the capital gains I had accrued. I sold most of my Apple position when I didn't want to, and it cost me like 10 grand on that. So these are things that we have to figure out. Like if you have these cash equity options, well, you have to know when they go ex-dividend. You have to know when someone's going to step in and snatch that from you. Where futures, you don't have to worry about that as much. There's no ex-dividend worries in the futures, and the settlements are a little more understandable. Does that make sense?
Yeah. No, I mean, I think that's really just an important thing to think about. People usually view American-style options like that's a favorable feature. I personally view it, even though I've taken advantage of it in the sense that a very common trade on the floors, especially in names like Philip Morris, anything that paid a big dividend, it was really common for us to do dividend spreads, try to, basically do dividend capture strategies because we had no incremental, transaction expense as dealers. Yeah. So we could trade tens of thousands of spreads if we wanted to.
And that depends on someone who's holding, who had written the option, not really being as sophisticated as you, correct?
Well, that's exactly the point, right? So for the self-directed investor who's thinking about that and saying, can I take advantage of that? The more important thing is not whether or not you can take advantage of it, but making sure you're not taken advantage of.
Exactly.
Because that's what generally happens. If you start seeing a lot of deep in the money or even just vaguely in the money call options trading right before ex-dividend, take a look at the open interest on the strikes that are trading, and you're going to see why these guys are doing it. They're hoping that somebody's not as aware as they are that those things are an early exercise, and chances are if you're short those calls, that's a good warning sign. If you're short in the money calls and all of a sudden that strike starts trading a whole lot,
get the hell out.
You probably want to do something and get out of there.
Yeah, no doubt. Again, it reminds me of the movie Rounders. If you're sitting around the poker table for a half hour and you haven't identified who the mark is, you are the mark.
It's you. It's you. Absolutely. All right, let's see here. So we have so with respect to expiration, how you handle if the question is when do you last get to make a determination if you are long or short an option about whether or not that is going to whether you can exercise it or whether there's a risk that you could still be assigned, that's actually going to be broker dependent for those of you who are paying attention. So for generally speaking, well, I would check with your broker on that and find out what that time is. I can tell you this, that whenever we had something pin, so that what is pinning, that just means that we had a lot of options on an underlying that finished at or very, very close to the strike price. We would hang around well after the close because our concern was, well, and anybody who's paying attention to this, if it drifts below the strike, the puts will get exercised, and if it goes above the strike, the calls will get exercised. And there's an auto exercise feature. So the OCC offers this as a feature to the clearing members that as a convenience, they will automatically exercise options that are a penny or more in the money. But you can always file what's called a contrary exercise notice. And any sophisticated dealer will do that. If they're looking and they see, I'm long the 100 strike puts and the stock closed at 99.90, they'll hang out until the last possible minute. And if they see that stock trading at $1.01 because some news came out after the close or the futures traded higher or whatever the hell it is, they're going to file a contrary exercise notice. And so if you're on the other side of that, you should also be aware of that. So you need to pay attention to where things are trading, not as of the close on expiration, but also where it's trading after the close, because that's going to impact those things.
So, Mike, I would add something to do and tell me I think you're going to disagree with me on this. So my thing is, because I've been on the phone with my clearinghouse wondering if I've got exercised or not got exercised far too many times on a Friday afternoon at 3:30. So now I'm of the opinion that they can take the last couple hours of decay. That's for someone who's that's their business. And I get out of things before they expire, just so I don't have to worry about the headaches. Am I being a sissy there?
No, I think that's a smart thing to do.
Yeah.
I can remember one of the biggest pin trades I ever saw was actually on the futures side. It was in crude back when I was on the NYMEX, and I was trading natural gas at the time. But I won't bother to mention the trader's name that I worked with. I don't know whether he wants it to be shared or not. He was one of the biggest crude options traders probably of all time on the NYMEX. He had massive, massive positions. And I remember that he, like everybody else in the pit, had a lot of pin risk on expiration. And he was trying to get out of it with other guys in the crowd, but everybody was in the same boat. So, nobody would let him out at what he viewed to be a reasonable price. And I remember... Now, the crude as a product was only open from 10 to 2:30, so it was very rare for traders to leave the pit during trading hours. But he left that day probably with about 90 minutes to go, and we went upstairs, and he said, I think I'm going to take the other side of this thing. Instead of trying to get out of my pin risk, I'm going to make a price where everybody else can get out of theirs. And the rationale he had was... if you're worried about what other people are going to do, it depends how many people there are. If you are the market, it's pretty much up to you what's going to happen now. So I remember he went in and he took down basically the entire pit's pin risk, and we took that on. So it was a little bit of a nail biter.
Yeah, that's nice. I don't need that kind of stress in my life.
He did make $4 million in a day, though.
I'll take that. I'll take a little stress.
Take that part. that works. Yeah, that's how it turned out. But the logic was that, you can get it. It kind of goes to that old saying where if you borrow $1 million from the bank's got you. But if you it used to be if you borrow 100 million, then you've got the bank. Right. I don't know whether that's the right number anymore. Maybe it's $1 billion or 10, whatever the number is. Yeah. It has to be a big enough number that they're more worried about it now than you.
Amen.
And I think that's essentially what that was the determination he made. Yeah. He thought, okay, you know what? I'll take down all the risk, and then I can live with it because
I love it. That's
it's just me versus one other side. Yeah. Well, we've already used up more than an hour, and I really appreciate you taking the time here. Let me see if we have another question.
Sure.
If you get a chance, can you give an example of how to construct a put and you mentioned put and call flies and condors, and how you would use them if you're bullish, bearish, neutral, etc. And you actually, so just a quick point before you get to that, because you also mentioned a condor. So you use, and I think people should think about flies and condors. Call or put, doesn't matter. Irons, I don't really care whether it's a call condor, put condor, fly, whatever, iron. If you could just outline how you use them to, because you mentioned you had a big one on.
Okay, so first of all, let's go with just a standard call fly, a regular balanced call fly. So where did the market settle around today? Where are the S&Ps? They get about, let's call it.
Let's see.
Just I want to use some relevant prices.
Oops, I've got the SPY trade here. I had my Bloomberg going, but it seems like 56.75 spot 12.
Okay, it's 56.75. So let's say you think we're going to rally, a couple percent, and on your chart you have a 57.50 marked as a place you think it could be in 2 weeks based on the time frame of your technical analysis. And I know technical analysis is not that precise where you can pick that in 2 weeks. However, call flies tend to be less expensive the further off they are. So even if you double or triple your money, it's a good thing. So if you bought like the 57 even, 57.50 call spread, that's the lower call spread of your fly. And then you sold the 57.50, 5,800 call spread. So what you've done is you've bought a call spread that's 50 ticks wide and you sold a call spread that's 50 ticks wide. By the way, is this working for you, this whole hand signal thing? Do you like it, Mike, or no?
Oh, yeah. And you know what I'm going to actually do is I'm actually going to do I'm going to come up with an equivalent. I'm going to put it into SPY terms because I actually have an application where I can sort of display this really quickly. But so SPY is right at, it's basically 1/10 of the S&P, of the SPX. So 56.75, so 567 in SPY. And I'm just going to
So it would be the 570, 575, 580 in SPY.
Mm-hmm.
Right.
So I'll do that now. I'll do that. I'm just going to build that in. And actually, these should be calls. So we'll just put that 570, 575. And how far out in time do you typically
Because that's a pretty wide call fly. I'd give that 2 or 3 weeks.
Mm-hmm.
3 weeks, let's say. Because that's what is the middle? The middle strike is probably 4% higher. I don't know. I'm just ballparking it, whatever. But it's, I would actually have some math if I was sitting at my normal desk. But anyway, so now you have this on, and you bought it for relatively inexpensive because remember, you bought a call spread and you sold a call spread to finance it. And the market has to go within a range of that middle strike for you to make your most money. What you really make your most money is if it's settled at the middle strike. If it's settled at 57.50, it would fill out the full 50 ticks of this call spread, the bottom one, and then you would take the decay on the 50 of the other call spread. It never happens that way. If you get into a call fly and think you're going to take it off right at the settlement price, you're fooling yourself. So what you just hope for is that it has a good positive delta, and then you monitor it. And then I have like a system, like if it doubles in value in the first third of the time I've had it on, I probably get it off. If 2/3 of the time to expiration is gone, then I need it to quadruple in value. And then if it goes all the way into the last day and it's still coming up into that where you make money zone and that call spread, that's where I start hedging around it with futures and try to make as most as I can. And sometimes it even works. Okay, but anyway, so the put condor that I bought um, when the market rejected a couple of weeks ago and it tried to break out the upside. I'm talking about the S&P, the SP futures. I bought a put spread and a good wide one, and I don't have, I can actually look up exactly what I put on because I put on. This was in the SPY, which, by the way, my licensing is for futures. I'm not telling anyone to buy SPY. Okay. I can technically, my lawyers remind me all day you're supposed to talk about futures more. But anyway, so I put on, and not a ton of them, but enough to make it into a good trade. The July went all the way up to July because it was so damn wide of a spread that I made. And I bought the 550 put to sell the 485 put. So I bought that put spread 550 by 485. So that's a 65 tick wide in the SPY. And then I sold the where's the sales? Oh, the 390 put 390. You know what I mean? So they're far away. But since it's July, there was still some good value in them. I sold the 390 put to buy, a bunch of I had to buy the 295 puts. I would have not bought the 295 puts, except the account I did this in was a retirement account, which they're like, oh, you can't just be short a put or whatever, or long that put. You got to sell something against it. So I did something that was very, very far out. So I got just a big old wide put spread. And if it gets down to 390, whereas the top strike of my other of this one that I sold, I'll take pretty much whatever I can get there. I think I'll buy the stock market with both hands. I'm willing to mortgage my house to buy it at 390, so I'm not that scared. Does that explanation make sense, Mike?
Yeah, I mean I think this is really interesting because I suspect that most self-directed investors, number one, on these types of trades probably are not going out that far. And I mean that in two senses. They're not going out that far in terms of the tenor. How long? Tenor is just another way options traders or futures traders sometimes, or bond traders will sometimes refer to, when something expires or matures. And the other is how far out in terms of money. But it's interesting. I mean, I'm looking at the price of this right now. It's about $9.50. And, the max value on that thing is $65. So, and to your point, I think this also is where having some sense of comfort with just the valuation of an asset really starts to matter, because as you pointed out, you would back up the truck at 390.
Yeah, give them to me.
And I think you can think about it in terms of valuation. You can think about it any way you want. You could take a look, and I encourage people to do this. Just take a look at the historic performance of an asset like an index, and take a look at the biggest drawdowns you've ever seen, and say, okay, would I have been happy buying an asset for, call it $400, that had been trading for $600? That's a pretty big discount, right? Mm-hmm. You don't get those kinds of discounts in equities that frequently.
Right.
And almost every time you had one, it was an excellent purchase in the long run. So
yeah, and every time I've been short puts like that in a trade like this, I like the fact that I get assigned, and it hasn't happened very often. And I always think to myself, if I didn't have a position on and was watching the market cascade lower, would I have the backbone to step in and take it? The options make it so I have to, because I'm not touching it. And if I'm going to get them, I'm going to get them. Yeah.
Some people will refer to doing things like selling a put as essentially getting paid to put a limit order to buy.
Right. Yeah.
So you've defined the level at which you are going to purchase the underlying asset and how much of it, and you're going to receive some compensation in the event that it doesn't get down there. And in the event that it does,
but also I want people to remember too how far away. This is a condor. So this bottom strike of the first put is hell and gone from this. This is a 485 put right here. This is a 390 put. So I can shoot down and make all the money on those call spreads and linger in that gray area for a while as it fills out and make a decent amount of dough.
Well, here's the other thing to think about, folks, and I think this is important too, which is that his effective purchase price is not 390, because he will have had a profit on that 550, 485. So if you put, let's call it, I don't know what you paid for it at the time. The market was higher.
All kinds
it was
of different
probably
prices,
less.
Up from
but maybe you spent $7 net to put on that trade. So $7 a share. So $700 per condor, right? The value of that condor at that second short put strike is going to be $6,500 per spread. right? So you paid $700. It's now worth $6,500. So you have it put to you at $390. Your effective purchase price is not $390. It's $390
minus
plus the $700 you spent, $397, less the $65 that it's actually worth. So you're actually going to be spending about $330, which is about 45% less than the S&P had been trading for at its highs. So that's a pretty big discount.
Sounds good to me.
There are not many circumstances where you get discounts that big, even if you thought it was overpriced.
Right. And by the way, if anyone's checking
level.
My prices, because I did when the market said, that was 3 weeks ago, when the market went high and was rejected, I bought a bunch of puts indiscriminately before I decided what the actual trade was I wanted. So I actually
you legged your way into it.
Yeah, I think I then sold out of that to buy this like a week and a half ago. I'm still way up on the whole entirety of the trade, but this one I probably purchased it at around 950, like it is now.
Yeah. So, and you already had profit. That's another important point too, right? So, if you put on I really like this, and I think it's an important point. Generally speaking, if the market has been doing very well, has been trading with low vol, options premiums are low. So you buy some puts. You think, okay, we're reaching it, it gets rejected. I think we don't have a whole lot of upside. We have more downside now, so you buy some puts. And a big risk that many traders have is they take their profits too early. But by legging into a trade like this, you're going to be doing two things. Number one, you're giving yourself the ability to stay in the trade for a longer period of time. Number two, implied volatility rose as the market rolled over. And so now you're selling options that are much more expensive than they were, not only because the market's lower, but because implied volatility is higher. So I think this is really an important lesson for people to
And it bumps out that skew sometimes too. Sometimes those ridiculous puts, like the 390s, not ridiculous because they're July, but they get bumped up even more than the near term ones when that happens. Oftentimes the skew pops out, which is nice.
Yeah. Well, I have kept you for more than an hour, and I really hope we get an opportunity to do this again.
I love this kind of stuff, Mike. I love talking about it. I think it's so much fun, particularly talking with smart people, getting the smart questions. Thank you. Right now I'm heading to my bar because it is St. Patrick's Day. So I will be heading.
It's gonna be a big day.
It's gonna be a big one.
Happy St. Patrick's Day, everybody! Check out Jim's podcast if you don't already, and you probably do because it sounds like it's going gangbusters. Like, subscribe, notification bell, all those good things, and Jim, have a great evening over there at Brandt's Palatine. If anybody lives in that area, go over there and get one of the burgers. I definitely want to do that, and let's have a chat soon. I want to join you on your podcast too if I get a chance.
I'd love that.
See y'all later, everybody.
See ya. So, Michael, you can still hear me, right? So I'm sure you figured this out, why I haven't asked